Good evening, everybody. This is Gary Full from LTG Trading. Wanted to do a YouTube video on the weekly E-mini S&P, which you know has been on a tremendous run, and I want to show you the vertical absorption in the bull run markets and why trend is so important to the markets. Today is January 1st, 2020. I want to wish everybody a happy new year and all the best for 2020. There's a disclaimer. Please read it, understand it. Substantial risk and loss in trading commodity options, past performance, not indicative of future results. The opinions of those who are Gary Full LTG are not to be taken regular buyers of commodity options. It's based on teaching of Richard D. Wyckoff. Also a disclaimer here as well. I'm offering 2 free weeks of my newsletter. Just throw me your email. We'll be able to send it to you in 1 free hour, one-on-one recorded webinar for you to keep, nothing to download, for your pleasure. The site is ltg-trading.com. Email if you want to get a hold of me is right here. So as you can see, the first thing we look at is trend. And trend simply is the higher highs and higher lows over a certain period of watching the market, albeit weekly, monthly, daily, whatever time frame that you may choose. This is the weekly E-mini S&P. As you can see, the market has been making higher highs and higher lows. Quite obvious. What we also see in the markets is every time the market tries to break and go lower, it gets bought at lower levels. This is extremely significant in Wyckoff because the composite operator buys value, just like any company would buy value. If you own a widget company, you want to buy the widgets at a price in which it's conducive to sell at a higher price to make profits. As you can see, the market makes some type of low. We have a retest, and what's critical about this particular retest is the slowness of the market going lower. We do not see high volume, wide ranges to the down bar. They're somewhat controlled ranges. We look for an area of support would be a reactionary low, and we draw the line across from here. The market holds quite nicely. We like the fact that the market reacts to that level. The market then has a high and close, low and close, high and close. Many times I notice those lead to some type of change of behavior, but not the change of trend. The market's a little bit tired, goes down, finally finds that demand at this level right here, reacts extremely nicely, again, making higher highs and higher lows. Market, so these little breaks that occur, we call them shakeouts. They are quick hypodermic moves to the downside, which then lead to higher prices and, in a bull trend, lead to new highs. Then we have a market that has an area where it's a reactionary high. We have a reactionary low down to here. We call this the trading ranges. This is extremely important. On the right-hand side of this trading range, we see high-end closes at the market and resistance. This is what we call vertical absorption. I'll write that in for us. It's vertical absorption. Simply, as the market tries to go a little bit lower, it ended up being on the highs, and the battle is won by the bulls. And the market goes up in a stepping fashion. This is a market that is vertical absorption, is absorbing the supply or the selling at higher levels. We then see the market going higher, another shakeout. We could tell by the high volume, the close, the volume is produced by sell stops being hit, taking out the weak longs being bought by the, say, the value of the widget company. Market goes higher, close on the highs, on the highs, on the highs. All part of vertical absorption. This becomes sometimes more bullish than markets that have wide ranges because it doesn't draw the attention away from large range bars. This market's designed to go higher, and we can get supply at any time, a larger range to the downside. But this is a bullish market without the supply. If the market has supply, we have to reevaluate the position of the particular market. In this case, again, the market has these shakeouts that lead to new highs. We can tell many times when the market's about to leave the trading range by the vertical absorption. That's what I have in my Wyckoff advanced series of what vertical absorption on the right-hand side of the market is. The market is in the ready position to leave the trading range, leaves the trading range, absorbs more of the selling, a quick shakeout into new highs. This is a current E-mini S&P weekly chart to the market. What will turn this market down is a large volume downside, a large range, and a test that does not show the demand to go higher. In this case, we want to follow the trend. We like to buy the market at edges of support, which if you look on my website, you could see many free videos, as well as other things that I offer. Please feel free to look on the site. Very bullish market. Can we retest back to here and still be bullish? The answer is yes. But we have to determine the speed, the volume, and the length of bar when the markets go down to those levels. At this point, it's vertical absorption. It's bullish. As people try to sell into the market, they have to pay higher to get out. This fuels the upside of the market. Again, I want to thank you for listening to this video. I want to wish everybody a Happy New Year. Please feel free to join the website. Please feel free to email me. And I hope that everybody has a great year. And we'll see you soon. Have a great evening, everybody. Thank you.